it's interesting too because since 2007, say, it's become very evident that there's been a distortion between the real economy and markets and asset prices. And if they have to go this route that James talking about, that's only going to get worse. And so you talk about productivity losses and business dynamism that you're kind of referring to. If they keep going this route, we're not going to improve in the real economy, and we're not actually going to see real economic growth like we want to see. So we got like 5 minutes left, and let's just tie it back to Bitcoin. All right. So
there's a cheery, side to this.
Yeah.
Look, all roads lead to Bitcoin.
Yes,
right?
sir.
So as we continue down this debt spiral, we don't know how long it will take. I can't predict out how long it'll take. Maybe 1 cycle, 2 cycles, but we're headed down this road. So when the Fed does, when they go and print to oblivion, okay, that's only going to serve to put more cash into the system, and it's only going to push assets like gold and Bitcoin up, okay? And when the system does finally break, then that path to Bitcoin is secured, and that's the standard that we will be on. And we've talked about this.
Yeah, I think it's just quite simple in terms of when you say gold and Bitcoin, and if someone doesn't really have any background, they say like, okay, we're at a Bitcoin conference, we're talking about bonds and inflation and all of this nonsense. What does it have to do with anything? And the reality is, with debt burdens this high, and I'm kind of surprised that so many people in the legacy system, fund managers, or just maybe Fed watchers, haven't really understood this dynamic yet. There's so much debt in the system that the only option is to print. The only option is to continue to monetize this thing. And yeah, they're tightening the belt now, but there is no other option for the Fed, the ECB, the Bank of Japan, the Bank of England, other than to continue to turn on the money spigot. Otherwise, the whole system unwinds to zero. We have a fiat-based system where the debt is the collateral that backs it itself, right? So when we're at a Bitcoin conference, it's my personal opinion and the opinion of these three up here, I believe, that's something that's absolutely scarce with a provable production cost, a verifiable production cost that's perpetually rising as hash rate continues to go higher, could serve as a solution. We have an engineering solution to this problem, and you can hold bonds or you can hold fiat currency and you can get pillaged, or you can opt out to a voluntary system, and this is where we are, right? It's volatile. There will be more 80% drawdowns in the future. Like maybe not, maybe 70 or 50 or whatever. The path is going to be extremely volatile, especially as the fiat system it's so over indebted that these unwinds we're seeing in the real economy, the financial economy, are going to be strong.
Yeah, and institutional investors who are entrenched in the old system they're starting to realize that these models are broken. They're starting to see it. There's 60-40 bond portfolio that you talked about. It's over. I mean, that
obliterated.
Obliterated. That's right. It's over. So, and that means that they're going to have to find a different way to make money, a different way to generate profit,
to save money, to keep money.
To save money. That's right. Good, very good clarification. So, yeah.
Yeah, no, I think, we try to find historical parallels to what we're experiencing today, just to try to learn about where we might be going. 1940s, Lynn Alden's made a lot of great comparisons there, given the debt levels. 1970s comes to mind. It's the last time we've seen any kind of sustained consumer price inflation. But the fact of the matter is we've never had Bitcoin exist, and like we have today, a decentralized sound money. So how does Bitcoin throw a wrench into everything? Dylan, I think one of the first pieces you wrote, you described it as a black hole, and that's what I think about. So why don't you take it real quick, man?
Yeah, so here's a fun stat for you guys. There's been 2 times in the history of U.S. financial markets that stocks and bonds have drawn down to this level in the same year. It's actually, there's only, I think, 2 or 3 years that they've ever both drawn down in tandem, but both of those years, they both drew down 20% plus, and this is one of those years. The years were 1931 and 1969. 2 years after, within 24 months of both of those events, the U.S. defaulted on its debt. And they defaulted, both times, they defaulted on their gold promises. One was FDR, who basically revalued gold higher and they confiscated everyone's gold. The second one was the Nixon shock, where they basically said, nope, global central banks, we're not honoring your promises. This is just paper money now. So here we are in a paper money world. How do they default on the debt? And once again, they're going to default in real terms. They're defaulting in purchasing power terms. They're going to do that by printing, debasing the currency. Creditors, bondholders lose their purchasing power. And where's that purchasing power going to go? That's the $100 trillion question. And that's why I'm here.
That's right. The Fed's going to run negative real rates forever.